Hi, I'm Pattu from freefincal. Today, let's take a look at the new offering from NSE, a new strategic index called the Nifty200 Momentum 30 Index. These are 30 stocks from the Nifty200 with the largest momentum based on their last 6-month and 12-month returns. As investors may know, I have talked about momentum investing and low volatility investing several times before. I maintain a stock screener. There you see that right there on the top menu of freefincal. This is a monthly screener that gives you the last 6-month returns, 12-month returns, beta, low volatility, and so on. Number of times, the percentage of daily positive returns, and so on. This is going to be a momentum index. This is the second momentum index in India, I should say. The first is the one from PSE, and I was amused to find in the evening that I was informed by friends that UTI mutual fund has now launched or is about to launch an index fund based on this very index. In the morning, I wrote that the mutual funds are unlikely to launch these indices because they can earn more from thematic indices. But I am happy that UTI mutual fund has gone ahead and launched an index fund. Before you get excited about the momentum index, there are several things you need to know about when it will work and when it will not work, and so on. So before we get to that, the momentum index will be constructed from the Nifty 200. That's the top 200 stocks from the that is the top 200 stocks in terms of market cap traded in the NSE. And what is important about is that many of these strategic indices, not all of them, but many of them have a cap weight of 5%. That is, they will not go, no matter how you can list these stocks in terms of low volatility or high momentum, but they will not be weighted in terms of that. Just like Nifty and Sensex, where you have Reliance Industries in both the Sensex and the Nifty is like 15%, 14%, something 16% roughly of that. Very high concentration and just a few stocks driving the Nifty, that problem will be lesser. It's not going to be eradicated, but it will be lesser by having a 5% cap on the weight. So the way they do it is the way they are going to weight this index is to take the free float market cap and multiply it by something called the normalized momentum score. This normalized momentum score will be based on 50% of 6-month momentum score and 12-month momentum score. So in order to measure the 6-month momentum score and 12-month momentum score, a momentum ratio is defined. So 6-month momentum ratio means the last 6-month return divided by the standard deviation over the last 1 year of standard deviation of daily returns over the last year. So 6-month return divided by standard deviation of daily returns over the last 1 year. 12-month momentum ratio is 12-month return divided by the same standard deviation, and then they will find out the Z-score. Z-score means, you imagine a bell curve. Yes, a Z-score of a positive Z-score means that stock has got a 6-month momentum ratio or 12-month momentum ratio greater than the average, and basically they will give more weight to Z-scores which are above average and less weight to Z-scores below average. So I have plotted this here. This is the kind of normalized momentum score versus the weighted average Z-score. You can see that higher the Z-score, the more will be the momentum score, and for below average stocks, the momentum score will rapidly fall down to very, very low values. So that's how they have constructed it, and it will have a weighted average of last 6 month plus 12-month momentum scores, and that's a very robust way to measure, to define an index. In my screener, I leave it to the user. They can decide. I have the 6-month returns, 12-month returns. They can decide on that. Also, there is a historical data of the historical monthly screeners are also available. They can, based on that, they can go ahead and screen themselves. Of course, momentum investing is rather a very volatile way of investing, and there will be a lot of churn in the portfolio. The number of the stocks in the portfolio will change. Therefore, this index fund news from UTI takes importance. Plus, please recognize that momentum will not work all the time. When you see a graph like this is the since inception data from 1st April 2005. of Nifty 200 Momentum 30, the total returns index. The red line and the green line, which are more or less superimposed over each other, is the Nifty 200 and Nifty 50. See, the Nifty 200 has got 200 stocks. Nifty 50 has got 50 stocks. But if you look at the return, if you look at the movement, index movement, you don't see any difference between them. They are basically on top of each other. This is the problem that comes from not having any kind of weights, allowing any weight. You just look at the free float and assign the stock with the highest free float the highest weight. If you do that, that's what will happen. If you have a cap, then you have much less concentration risk. Of course, the strategy for selecting the stocks, that will define the risk primarily, but secondary concentration risk is much lower if there is a cap weighting. Now, if you look at this, it looks like the momentum index has done extremely well, but what you're looking at is only one return. You're seeing the movement from this value to that value. You're basically looking at one return, and you should not get distracted by this and think that momentum indexing is a great way to get returns. That is not true. Momentum will not work all the time. Nothing will work all the time. So over the period from April 2005 onwards, it's just backtested data. This is the maximum drawdown, that is the maximum fall from the peak, and you can see the black line, which corresponds to the momentum index, has got the highest drawdown. But the most important thing you should understand is during the time when the market was not doing anything, after the recovery, that is the stock market fell in 2008, then it recovered after the Lok Sabha election, that is when the Manmohan Singh government got re-elected. From that time, over the next almost 4 years, the market was not doing anything. It was going up, down, and so on. During that time, notice that the drawdown is very high for the momentum index compared to the market cap based index. That is what is a problem with the momentum strategy, at least from what we have seen here. When the market is not when the market itself does not have momentum strategy can be very risky. When there is a start of a bull run, then the momentum stocks will, you are basically choosing the stocks which are moving faster among the portfolio of stocks, that is among the Nifty 200 portfolio. Therefore, naturally, you have a better chance of getting returns. Nothing will work all the time. Same is true of momentum also. So this is a comparison of the BSE momentum, which is in red, the NSE momentum, which is in black, compared with the Sensex, which is in green. Not much of a difference between this and that. Probably small differences in the determination of the weights. I don't remember the BSE method. Other than that, it's not something to worry too much about. If you look at the 5-year rolling return, each colored line has got 2,601 5-year data points. The yellow line is the Nifty 50. Again, it gets crashed. I don't know why this quick time keeps getting. I never had this with this problem with the old Mac. If somebody knows the answer, please let me know. I never had this problem in the old Mac, but in the new Mac, the quick time, that video gets crashed. But I can continue recording, which is with this button here. That's going on. Anyway, so the yellow line is the Nifty 50, the white line is the BSE momentum, the blue line is the Nifty momentum. Notice that during the sideways period, there is not much difference between the momentum and the Nifty 50 index. And only when the bull run starts, the momentum starts picking up. And in terms of standard deviation, amusingly, there's not much of a difference. The day-to-day volatility is not much of a difference. Of course, momentum is a little bit higher than Nifty, but it's not that much higher to be worried too much about. So the new development from UTI that they're going to start momentum index is interesting, but there's no need to immediately jump in. You have to look at the expense ratio and so on. So let's be calm and wait for this development. But it is interesting. I think UTI, if they go ahead with the launch, please recognize they have not launched the NFO. They have just filed it with SEBI. They may not go ahead with it. See, Motilal Oswal also filed an index fund for large Nifty large mid cap 250 index. They filed the NFO, but they did not go through with the launch because they went ahead. They got greedy and launched the large and mid cap fund. Same thing may happen with UTI also. So let us see. Let's wait for the listing. Let's wait for the expense ratio. There's no hurry. But please recognize momentum will not work all the time. That much you should know. Nothing will work all the time. Bye.